Fred has a coin company, and what they do is they buy and sell gold and silver coins, real American money. Most of them are collectibles, and they come in the little plastic guys that are all graded by, who's your main guy, Fred? NGC?
NGC. Yeah,
NGC.
best service on the planet.
And they're all
And
graded.
most of what we've been
Go ahead.
the 64 dimes and quarters and halves, that's just loose stuff. That doesn't really need to be graded. I mean, we're just literally talking about old change.
Right.
The popularity of that side of the market has exploded. It's been very interesting where of all the things within our industry, it is the most commonly available product, or the just bulk. They call it junk silver. It's an expression I've always really hated.
Yeah.
But it's a reference to circulated dimes, quarters, and half dollars from 1964 and earlier. And even that, as it is the most commonly available product in our industry, I mean, we're not talking about a $3 gold coin where there were 25 minute in proof condition and one or two show up every decade. We're talking about the stuff that was minted in the largest bulk quantity and generally is sold in huge bags of tens of thousands of coins at a time. Even that product is becoming scarce enough to where the prices for them, the premiums over their melt value, have been climbing this year. In fact, three price increases in the last 30 days.
Just on this, and we call it currency silver, right? Currency silver rather than junks. Yeah. When did they start making these dimes and quarters and halves? When did?
Well, they started actually all the way back into the 1790s. The most common stuff we're dealing with, like the Roosevelt dimes, they're from the 1940s and 50s, and the half dollars are mostly the Franklins and Kennedys from the 1950s and up to 1964. We always use an expression pre-64. That's technically not correct. It's really pre-65 because the date of 1964 is really the cutoff. The strange thing is a silver quarter minted in 1964 is 90% silver. A silver quarter from 1965 has zero silver content in it.
Oh, those rascals.
So we went
boom, right off the cliff.
No slight transition. It just was all or nothing. It was either we made it out of silver or we didn't. So anything 1964 dated or earlier were coins that were minted by the U.S. government, just intended that the public would use them. They were not special. They were not minted for any collector. They were just the regular money of the day. It was just that in those days, there was a requirement under federal law that money had to be legally issued under the law, under the constitutional definition of money, and that required that the coins be minted of a precious metal, so that the public wasn't, just accepting a currency that had no financial base to it. So that changed in 1964. But amazingly, as much of that product as we minted, it's becoming a little bit difficult to get in quantity, where for years, all the years, I'm 37 years into this business now, we always had dozens of dealers that had huge supplies of this pre-64 coinage that, if any dealer individually ran out, there were always places to go, like the wholesalers that had this massive quantity of this product. That's not the case anymore.
They just don't, huh?
Nobody has this overhanging supply anymore. And as fast as these guys are getting inventory in, dealers are absorbing it. Customers are buying it. Dealers are selling out. They're going back to replace, and they can't quite get the product quite as easily or readily. And every time, even with the price dropping in silver, the premiums are climbing because everybody's terrified that, if we sell out of what we have, that we may not be able to replace it.
Yeah.
So everybody's leapfrogging the next guy to try to make sure that they secure the inventory. And I just find it interesting that that's happening on, again, the most commonly available product within our world is facing a supply problem for the first time in my career.
First time in a long time, 30 years or whatever. Which ones are more and less? If you take it dimes, quarters, halves, and silver dollars, which ones are the most available?
Dimes and quarters.
Dimes
They're
and
pretty
quarters.
much equal. When, years ago, not even that long ago, maybe 10 years ago, dollars, silver dollars, which ended in 1935, so they were a little bit older than the 1964 dimes, quarters, and halves, and less fermented of the dollars. They always had the same, minimal premium that half dollars, quarters, and dimes had. So you could, interchange them readily. You can get a bag of dollars as easily as you can get a bag of halves or a bag of quarters. A bag, by the way, is a reference in the industry to 1,000 face value. So if it were silver dollars, it literally would be 1,000 silver dollars.
1,000 silver
If
dollars.
if it were a bag of dimes, it would literally be 10,000 dimes to come up with 1,000 face value.
Wow.
And that's about 52 pounds.
How many?
It's like
52 pounds?
52 pounds.
And
Like a
silver,
bowling ball square off.
so silver is about $25. So if we go 52 times
$1 an
16,
ounce.
and we got 832 times how many? That's 832 ounces. Oh, times $25.
24, yeah.
Yeah, so what do you sell it for?
Well, bags of silver will sell for around $25,000 or so
Yeah,
in
it's
today's market.
21,000 silver value.
The melt value, right?
Melt
So
value,
the
melt.
premium of melt is still, even with the cost increases we've seen recently, still very, very attractive. Interestingly, the dollars began to separate themselves about a decade ago, and now they carry a premium of twice as much as other coins. And then in the last 5 years, the half dollars began to separate themselves just a little bit from the quarters and the dimes. So the premium on halves is about 10% more than the premium on dimes and quarters. And again, this is a reflection of availability. There were less larger coins minted as traditionally was the process. So it makes more sense that you would start to see a little bit more premium on the lesser available coins. But as they used to trade all together, as this demand is stripping supplies, we're beginning to see everything separate. There may come a time where people are paying attention to the individual dates on these things and start paying, premiums
No
for
kidding.
them. But I find it interesting that the premiums are going up so dramatically when the price of silver has basically been fairly stable.
Yeah. Fred Dashevsky is with us. His company is US Coin Capital, and which is 888. No, that's
800-878.
878. You do it. I have it here. 800.
800-878-2646.
I mean, I got it right here in front of me. I mean, give me a break. 800-878-2646. Our phone number, if you care to join Fred, is 888-663-6386. The email, patrick@oneradionetwork.com if you have a question. I'm going to go back a sec. I was curious about that law. So there was a law in place, Freddie, up to 1964 that said something like the Treasury, if they issued coins, they had to be in real money, but not dollars.
Well, everything had to be issued
Oh, that's
in
right.
terms
Dollars
of real
had,
money.
yeah, the dollars had to be backed by gold back. No.
Right, or silver, so it had to be a redeemability to the paper. It wasn't anticipated that we would ever have an unbacked paper note. The idea was fairly simple, that the word dollar was defined as a quantity of gold and silver. I know that's a little strange to think about, but Andy used to talk about it like, if you think about a gallon, you don't ask for a gallon, you ask for a gallon of something, a gallon of water, a gallon of milk, a gallon of gasoline. So a dollar was a dollar of something. It was a dollar of gold or a dollar of silver. And the concept was fairly simple, that, a paper note didn't float on its own. It was actually something legitimately backed by gold and silver. And the old notes, before the 1920s and 30s, actually stated on them their redeemability clause. If you read an old pre-33 note, it said this is payable to the bearer on demand, $1 or $5 or $20 in gold coin.
What fun.
And that you could redeem that at your discretion. Right? Walk into a Federal Reserve Bank, put your $20 gold bill on the desk, and they'd hand you a $20 gold coin, which was the redeemability clause. Now, after the 30s, when they took the gold standard, they changed it. They left the standard of gold against the dollar, but removed the ability of American citizens to ask for it.
Yeah,
We were promised in 1933 they would retain the standard, but they weren't able to provide the redeemability.
right.
And the redeemability is sort of our backstop, our security blanket. Like, let's say, for example, you look at the markets today, you look at the world today, and you express your concerns. You're saying, hey, I'm uncomfortable with what's going on. I don't know that the government is doing a good job sustaining the value of money, and I don't anticipate that they've got good control over the economy. So I'm losing faith in this paper note. Well, I could always walk into the Federal Reserve Bank and just simply demand that gold or silver against that note. I didn't have to count on the note. I knew it was redeemable or backed by something real. By 1964, the problem became too much for them to maintain that reserve. They'd overprinted money. They knew it. There wasn't enough gold or silver on Earth to back up all the paper they printed. So they simply removed the standard. And by 1964, it cost more than 25 cents to make a 25-cent quarter out of silver. It cost about 30 cents worth of silver to make a quarter. And that created kind of a big problem. How do you produce a 30-cent quarter and put it into the economy?
That's right. So I see. So it came, the dollar went first in 33 off of redeemability. And then how did they do this? Just by edict, by executive order? Was it a bill passed by Congress to take the silver out of the coins? Do you know?
Yep. They basically were forced, the hand was forced by reality. So, Congress was forced to accept the nature of the problem, being that, we could either lose money printing money out of silver, which didn't make any sense.
Sure.
Because, if I gave a 30-cent silver quarter, you could melt the silver in it and get a nickel more than the face value. So if you did that with large quantities of money, two things would happen. You'd be making a fortune for basically nothing. And of course, none of these coins would circulate because they don't get melted down for the melt value. So that defeated their purpose of being produced. So after 1964, the government turned around and said, okay, we need to change the standard, and we're just going to produce coins that have no metal content anymore. And they sort of try to appease people by saying, well, we still have silver certificates that are floating around. And, if you want to travel up to, New York, and if you want to go to West Point, we have a stockpile of silver. And if you want to bring your silver certificates, and those were those notes that had the little blue seals on them, and they said silver certificate at the top. And if you accumulated those and you wanted to redeem them for silver, we still have a stockpile of silver. But the coins, well, they're not going to carry any metal anymore. We just can't afford to do that. And ever since then, we've been running on this non-metallic standard, and it has allowed for an inflation problem to persist. It's also allowed the government to create unlimited amounts of debt, knowing that if it has to produce more money, it doesn't have to have any gold or silver to back it.
Do you do you know the law? What was the law in place where they had to make the coins in silver? Was that do you know what law that was?
Well, it starts with the Constitution definition of what a dollar is.
Right.
So, the subtle change was to stop talking about them as dollars and start referring to them as Federal Reserve notes. So, although they say $1 on them, technically they're not. They're actually Federal Reserve notes. So what they did was sort of a legal maneuvering of wording, sort of a color of law word. If you do, you sort of change the nature of the definition of the word.
Dollar to Federal Reserve note, right? And that happened happened in 1913.
Well, it started, yes, 13 was the beginning with the Federal Reserve Act. 1933 was the end of the gold standard of producing gold coins for currency. 1964 ended the production of silver coins. And the changes in the laws came from Congress over the course of time, where they would direct the Treasury to mint different types of coins, either made of silver or not. And again, as the reality kicked in to where they realized it was just pointless for them to, perpetrate the nonsense of trying to maintain a standard, they would just force the public to accept a non-backed currency. So, LBJ, would pass laws, and they would start to happen in the Kennedy administration, where they began to realize they were coming to the end of this era. But up through 64, we were able to sustain this. It was one of the things when I was very, very young in this business that troubled me. It sort of struck me as odd that we have been able to maintain a standard of silver and gold coin against our currency from 1792 until in my lifetime in the early 1960s, where suddenly we couldn't do this anymore.
Yeah,
we were just going to
accept.
I was like, why was it suddenly now, going to change? What was so different about our economy, or were we making some sort of right decision that people before us, had made a mistake or something? And I just didn't really believe that. I just felt like we were being screwed, and I didn't understand it, because I was too young. And I remember when Nixon made that announcement that we're taking the gold standard off the U.S. dollar, and his pretense was that there were foreign powers that were creating problems for the U.S.
By
dollar
buying
by
dollars.
manipulating
Yeah. But Fred, do you think if they would have been like all good guys in a Walt Disney movie, that they could have figured out a way how to keep the gold thing going? I mean, could they?
Well, here's what would have happened. They wouldn't have been able to finance the debt
Right.
without having removed the gold standard. So it would not have allowed, for example, I don't think we could have entered the Vietnam War. We couldn't have paid for it. So there were a lot of things that would have been vastly different if we had sustained that. And I think when the reality came to be that the government recognized that unless it changed the way that it issued money, it was going to have to fiscally become responsible. Their choice was, well, we either take care of the public and really curtail government spending, and that would also limit the growth of the U.S. economy. I mean, we couldn't have expanded the U.S. economy quite as rapidly if we didn't float money. So we wanted to float the money to let the economy grow more rapidly, but also to pay for massive amounts of government debt beginning to climb. And as the Vietnam War issues, became more and more prevalent, again, expenses began to grow, and it became impossible to finance the future debt with a standard of gold and silver. I mean, it's like if I told you that I'm going to limit your credit card spending every month to, let's say, $5,000, and you wanted to spend $7,000 a month, and I'm telling you, I'm locking you down at $5,000. Well, then that extra $2,000 that you would have spent, you can't. So you would have learned how to, live more modestly, or that you would have had to give up things that you wanted to buy. And the government did not want to make that decision. It did not want to be limited. It wanted to continue to do what it wanted to do without that curtailing process of having to maintain real money. So it said, well, what if we removed the standards and it allowed the money to float? Then we could spend a lot more money we don't really have now, and it'll create a little inflation. But if we do this in a sustained kind of control process, it won't get out of control and things will remain okay. And, a gallon of gas was 25 cents, and, a loaf of bread was, what was it, 1964, a loaf of bread, I want to say 59 cents.
I don't know.
And if we go back and look at those things and look how they changed, this was the problem. So it's the same kind of problem we face now. The government plays this game. We've talked about this a couple of times, where Congress sets a debt limit. And it says, okay, we know we're deficit spending, and we don't want to let this continue indefinitely. They try to pretend that they care, or they think that they can control this stuff. I think it's all a bunch of crap. It's just a bunch of political nonsense. But they're going to go out there and play the game and say, we are worried about the deficits of the government. So we're going to set a maximum and say, if we hit this level, that's it. The government cannot spend another penny beyond this number.
They call the debt ceiling, right? The debt ceiling.
That's the one. So if we hit this debt ceiling, we have to do several things. We either have to stop spending, or we have to raise more money. But we cannot go past this debt ceiling. Well, what happened when they hit the debt ceiling? They just simply raised it. They moved the bar. They moved the goalposts, as they like to say in the sports analogies. They just simply changed the rules. Okay, well, we hit that debt limit, and we weren't able to hold it. So instead of doing what we should do, which is curtail spending or raise more revenue, we're just simply going to raise our limit at how much we can deficit spend. And then we'll go forward from there. And then they hit the debt limit again, and they continue to raise it. Now, once in a while, there would be some pushback. If you remember, like when Newt Gingrich was speaker, and they had this whole big pushback and saying, well, we don't want to go beyond the debt limit, so that means we're shutting the government down. We're out of money. We're going to shut the government down. And they did. And they would start shutting down government services. And, of course, there was the big backlash. And now politically people are saying, well, is this the right thing to do? You're cutting off government employees, and you're closing government services and offices that the government runs, including some necessary ones. And then how do you deal with that? Well, eventually the pressure would build and they'd yield and say, well, we have to reopen these government services. So guess what? We're going to raise the debt limit again and again and again. They've raised it about 12 times in the last 20 years.
Oh, yeah.
We're about, I think we're a couple of weeks away from the next debt limit.
Oh, I didn't even know they still had a limit. I thought they were just blown and going now.
Well, it's a joke now. I mean, it's almost a non-event. Every time we get there, everybody knows what they're going to do. I mean, do you really believe that if the government hits the debt limit, let's say it's in a couple of weeks, that they're going to stop spending money they don't have, and they're going to start to raise the revenue they need to cover the gap. That means raising taxes and slowing down government
Not going to do it.
spending.
Not going to do it.
Not going to happen, especially in this kind of economy where the need for the government to intervene in the economy has become essential, because we wouldn't have an economy right now. We would be in a massive recession if the government intervened. Pandemic, if you remember, the Obama administration was facing almost a recessionary economy. The economy had slowed down, growth had slowed down, employment was, terrible. And they said we'd never see, these numbers for employment again, and we would never see this kind of growth in the economy again, and we just had to get used to it. So the nonsense persists, and it all harkens back to this basic, simple concept of, can you control the nature of money or not? And if you're going to give up the idea that you're going to control the real value of dollar, well, that means that people who are trying to save money better be ready for that dollar to change in value, because we're going to print more money now, and we are not backing that money anymore with any physical metal, which means that we're simply diluting all of the value of existing money, and we're printing a fiat currency. And that's, fine from the standpoint of, the government, but how does that fare for the public? You don't get to print money in your basement when you run out. If you're out of money this month and you need more, you can't not go down to your basement, crank out a few hundreds and say, okay, now I can pay my bills, right? You're not allowed to do that. The government can, but you can't. So you have to exist on the value of the money that you have to work and earn, which means that you've got to, put out that energy. You have to impart effort. You have to labor. You have to invest. You have to do something to generate that additional revenue. But that dollar that you're creating is perpetually being inflated by forces you can't control. And this is why I believe people need to own that physical dime and quarter and half dollar in their possession, because these things cannot be inflated. You can't go back to 1964 and flood the streets with more silver dimes to compensate for a demand problem. We only have today in 2021, whatever supply of these things has survived. That hasn't been melted, destroyed, or put away for generations, that'll never show up again. Whatever's floating around in the open market is it forever. And as people put that away, what they're finding is the values are growing, not only because the underlying price of the metal they're made of is increasing due to a normal inflationary problem, but also, we've always suggested this, the advantage of coin over, let's say, the bullion world, the bars and the bricks, is that there is a fixed supply of dimes and quarters and silver dollars and halves. And because of that, we are now this year experiencing exactly what we anticipated. That part of the value of those coins is growing, even separate from the movement in the precious metal itself, because supply and demand characteristics are beginning to take hold.
Regardless of what the price of silver is, your silver prices are going up because of supply and demand. So it's pretty cool.
Exactly.
It's actually running the numismatic model, even though they're really not numismatics, with dates and rarities, right? They're running that same model parallel. Pretty cool.
Now, I can understand this where, the 1933 $20 that sold for $19.5 million at auction a month and a half ago, it's a one of one, right? It's a one of one coin. There is one. It's the only one that exists, pristine condition. A coin like that having massive value, I get it. A 1799 10 that passed through our hands last week at, $75,000. Again, I get it. It's a 200-year-old plus coin.
75 grand for one coin?
Yeah, 30,000 minted, might be 100 examples known. This was one of the better ones that have been out there and, found in the last few decades. It makes sense to me that coin would carry high value, way beyond its metal content. Mm-hmm. But to see that begin to happen with dimes and quarters and halves, let me tell you something. The American public is getting voracious in its appetite to accumulate physical silver and gold. This market is expanding so rapidly. Demand is beginning to really become an issue. And again, I've never in 37 years ever been in this industry where there is no huge supply somewhere of this generic dime, quarter, half dollar supply market. It's just becoming a little bit more tricky. There have been 2 or 3 times this year I couldn't even get, bags of quarters.
You couldn't even get them. Wow. Well, as
Yeah,
you
couldn't
know,
offer.
there's a lot of more people, in the underground world like us, where we're talking about, the Fed coin and probable issues, and maybe, these wackos shutting down the internet for a month just to piss us off, or whatever they're going to do. They're going to keep at it, whatever this is. They're not going to let up now if you look at the history. So, there's some real benefits to having these guys. Who knows? Buy some food with it someday, or
Well,
just
think about the economy. Think about where the economy is right now. So we've had a pandemic. Okay, everything else notwithstanding, forget about all the things, and when we could spend weeks just talking about before the pandemic, all the things that have occurred that have caused government debt and the massive accumulation of the 31 trillion or so in debt we all understand exists. So now this pandemic hits on top of everything else that previously existed, slows the economy down to a screeching halt. Right? Everything comes to a screeching halt. Now the Fed is forced to deal with forces that are sort of opposing simultaneously. Number one, it needs to stimulate the economy to try to get it to move forward again.
right.
Because again, the pandemic has brought it to its knees. We have a very slow moving economy. How do we move the economy forward? Well, the Fed has methods to intervene. The most obvious one is you lower interest rates, and you keep lowering them to make money more readily available. And if we do that, we can stimulate economic activity. But what if the Fed lowers interest rates to zero and that wasn't enough to move the economy forward? Okay, well, we create new methods.
Which is
to
what
move the
happened,
economy.
right? As close to zero as I could get, right, Freddie? Okay.
Exactly. I mean, down to a point where 10-year money was 0.8% at one
Yeah.
point. So what is it now? 1.3. I mean, on a
1.3,
10-year
I
note,
think, for 10-year, right? 10-year.
incredibly low.
Yeah.
So you could borrow money a lot cheaper than you could before, and this is going to stimulate the economy. Now, simultaneously, the Fed said that wasn't enough, so it began to pump, literally just push money into the economy. It did that by buying debt from the U.S. Treasury. It did that by supporting the mortgage market. And it would do this month after month after month. And the numbers started to grow, where the Fed was intervening at, 100 billion, 110, 120. We're at 120 billion a month for almost 2 years now, every month that the Fed has been pushing into the economy to try to do exactly what we're talking about, which is to help this economy move forward, because the zero interest rates, or roughly zero, wasn't enough. So the Fed has intervened further, and it's continued to intervene by doing this purchase of assets and mortgage securities. Even that has not had enough impact. But simultaneously, while that's happening, the Fed is beginning to recognize that there is an inflationary problem. So all of this money they've been pumping in for the past 2 years is having an impact.
Because
That
it's
impact-
chasing the same amount of goods, which are not really growing because of GDP is low, right?
Exactly.
Good.
So the rate at which the money has been growing is way faster than the rate at which the GDP is growing. So the economy can't absorb all that money being printed, which means there's an overhang of lots more cash floating through the system. Now, the benefit of that, it tries to help the economy move forward. The downside, it creates. What does the Fed do to fight? Raises interest rates. But it can't do that quite yet, because it still has this really aggressive asset purchase process going on. And until it slows that down, there's no point in raising interest rates, because there's a contradictory process.
Okay, let's slow down a second with that. Let's understand that. So what we're saying is the interest rates are low, and to stem too much juice getting out there, they could raise them a little bit, and people won't borrow as much, and will slow down the flow of money in. But they're also buying things on the other end. Last week, they raised the money that they've created at the Fed, 1.4 trillion, just last week. 1.4
Right.
trillion. This is on their balance sheet I'm
Right.
looking at this morning. So you say, I kind of lost you there. You say they can't do both, Fred? They can't raise interest rates and stop. Say it again, I didn't quite understand.
Okay, so there are two things that the Fed is doing. One is to lower the rates. The other is to create all this money to buy these assets.
Right.
Both of those have the same impact on the economy. There are two different ways to do the same thing.
Getting
which
more
is to
dollars
push
out
the
there.
economy,
Right. Yeah.
getting more dollars out there to the economy to make it flow through the economy more quickly, and this drives forward economic activity.
Uh-huh.
But you can't do one against the other. In other words, simply lowering interest rates or raising rates, for example, without slowing down the asset purchases, it's like two opposing forces. They both do the same thing. They would negate each other. If you didn't slow down the asset purchases, raising rates wouldn't do anything. It wouldn't have the impact because you're still pushing money into the economy.
You got to
at
do
an
both, you're
incredibly
saying.
rapid
You got to
pace.
do both.
You have to do both. You have to stop first with the asset purchases. That has to come first, which means the Fed has got to turn to the economy and the world and say, we are no longer going to intervene. We are no longer going to be the biggest buyer of the bonds. We're no longer going to be driving money into the stock market. We are no longer going to be driving the value of houses up by buying mortgages from the banking
Mortgage-backed
institutions.
securities. Has
Correct.
Paul
And if we stop
has he
doing
gotten close to even saying that at the meetings? Not really, right?
Okay. Here's what the Fed said. At the beginning of the year, the Fed said, we're not talking about lowering rates or slowing asset purchases. We're not even going to talk about talking about it.
Good.
Now, because inflation numbers keep showing up higher than they anticipated, now they've said, okay, we are talking about it. And then they've moved from that. Yeah, that's it. I know it sounds ridiculous, but they're terrified. The Fed is really worried that if they come out and flat out say, hey, Patrick, as of tomorrow, we're no longer going to be an asset buyer.
Right.
We're not buying any more bonds. We're not buying any more mortgage-backed securities. Do you have any idea what impact that would have on the stock market, the bond market, and the housing market simultaneously?
Let's
It would be
see.
a disaster.
Would it just
Disaster. Prices would plummet. Bond yields would explode, and rates would drop. Values of mortgage securities dropping would mean the housing market boom would end overnight. And the Fed does not want to have a massive reaction by overdoing its power. So it has to slowly slow down its asset purchases. And let's say, and I think this would be massively aggressive, what if they dropped from 120 billion to 100 billion? That would be huge. That's a massive decrease. I don't think they'd really have the guts to do that much. Even at that level, dropping to 100 billion a month, that's still 1.2 trillion a year that they're pushing into the economy. So they really have not done a lot to change the direction of what's driving economic activity. They have a long road ahead of them to slow down this asset purchase process to try to get to a point where once that's low enough, then they can turn around and say, okay, now we can start talking about raising interest rates. Because again, if they simply raise rates but keep buying the assets, they haven't done anything.
Yeah.
They're again, the two forces that work together. You can't do one and then leave the other and expect anything to change. It doesn't make any sense.
so?
The Fed
It kind of feels like for the immediate future, they're just going to keep doing what they're doing, right? And why inflation will
I think
probably
so.
keep going up.
Yep, inflationary problems are becoming real persistent and a real headache for the Fed because the Fed understands the nature of this dual-edged sword. Number one, they want to fight the inflation they're creating because they don't want that to get out of control. They know that devalues the currency. They know that hurts people's wealth, and it's not healthy. But they also know that they can't act too quickly because it's sort of like, tapping the brakes on a car when you're doing 80 miles an hour or slamming the brakes. You don't want that knee-jerk reaction to fly people through the windshield. You need to slowly bring that thing to a slow down, not really just slam on the brakes hard. The Fed is sort of stuck without the ability to make any single decision that would fix the problem. They've utilized all of the gimmicks in their little bag of tricks so extensively now that they're left with very limited options. And meanwhile, the government keeps spending additional money. So the Fed is fighting this monstrous problem on the government side because the government has taken upon itself to say, well, yes, we have massive debts. Yes, we have an inflationary issue, but guess what? We want to put out all these new government programs. We want to do a massive infrastructure bill. We want to spend $1 trillion and stimulate economic growth by doing X, Y, and Z. Well, the Fed is sitting there saying, oh, great, we already have a huge problem. Now you guys want to spend another $1 trillion, and that means that we're going to have to fight that off as well as everything existing now. The Fed has really got itself into a pickle. And I don't believe that the Fed knows what to do.
Yeah.
No one has ever been in this situation before. There is no there's no blueprint for this. There's no book that the Fed can say, "Oh, okay,
Yeah.
when you have this, this is what you do."
They don't know what to do.
That doesn't exist.
So you keep track of it pretty well, I think. In general, when the Fed puts out a hundred, say, or $100 billion treasuries, 10 years or whatever, how much does the market eat up of that generally, the bid to cover? Do you know? Can you guess?
Well, it depends. It changes a little bit month to month, but
Does
the Fed is buying. I'd say it's probably 80% of it
80%?
is going on the Fed's balance.
Wow.
More maybe on any given month. There's a guy named Rick Santelli. He's terrific.
Sure. Yeah.
He's a reporter at CNBC, works out of Chicago, and he kind of gives them a school grade. Every time there's a bond auction, he's like, okay, how well supported was this bond? So
people want to loan them government
X
money.
Yeah, how many people wanted it this week? Well, maybe he gives them a D. So that means that nobody wanted that debt this week, and the Fed bought 90% of it. And then every once in a while, we'll have an A rating, and they say, yeah, okay, so there was good support that week. What's happening is that every week, guys who have massive amounts of money are short-term minded, looking at the current rate and saying, well, if things look like that rate might creep up a point, 1.3 to 1.4, any little increase, when you're dealing in billions and billions of dollars, that amounts to quite a bit of money, and they might profit from that. So they may be an aggressive buyer that week. And then the next week, they look at the rate that's being offered, and they're like, well, that's not as attractive to me anymore, so I'm not going to be an aggressive buyer of that. And the Fed steps in and buys it all.
Yeah, but wait a minute. I kind of lost you a minute. Say if the rate is 1.2 and I have $1 billion, why would I spend my billion on the 1.2 worth of 10-year notes if I thought it might go to 1.3 or 1.4? I'm going to lose money.
Right, you wouldn't. It's the other way around. In other words, if you think it's going to be lower the next time they come out, you'll buy the higher paying yield. So you're worried that the next one will be paying higher than what you bought it for. So you're looking for the opposite. You're looking to get a better rate of return than what might come out next month.
Well, that's what I mean. So why would I spend my money now if I thought it was going to be going up? Is that why the bid to cover is low?
Yes, exactly. If they think the rate will be paying higher next time, then they'll be less aggressive. Bye-bye. But again, it's almost on a monthly basis that guys have to decide what to do with all their capital.
Sure.
And again, if you're short-term minded, you could shift it into the bonds for 3-4 weeks, and then out you go. The problem is if the rates do go up, then it makes that existing bond worth less, and nobody wants it. There's less demand for it. That secondary market, it gets harder and harder to find. Now, if the gap is small, you could still unload it, but if the gap gets wider, you're right. Who's going to want a bond that pays 1.2 if you get one that'll pay 1.4?
So in general, going back to the stock market, which most people have, Freddie, all of their 401ks and all that in, the idea is that all these purchases by the Fed, which it looks here since August 18 to August 26 on the Fed's balance sheet, it was plus 1.4 trillion. So that's a lot of stuff, whatever they're buying. A lot of that goes into the market, and that's what keeps the stock market, the Dow, and up. Is that right?
Well, absolutely.
Okay.
Getting into the market, the Fed's purchase of these assets supports the market, and again, keeping these rates low also gives an opportunity to a corporation to borrow money at next to zero rates.
And they could go into the market too, right? Yeah.
Buy their own stock.
Oh, buy their own stock.
So let's say you're a corporation, the Patrick Duponi Inc., and Patrick Duponi can borrow money at 0.5%.
Good for
and
me.
Then go out to the market, buy all the Patrick Duponi Inc. stock, and then use that money and raise the value of the stock 2%, so that you can benefit from that increased value in the stock more than what it costs you to borrow the money. Well, why wouldn't you do that? All your shareholders are going to love you. I own stock in Patrick. I'm thrilled because my stock went up. Why did it go up? Because you bought the crap out of it. Do I care why it went up? No, I don't care.
So this happens all the time, right? With the Googles of the world, the Apples of the world, Teslas, and all that other world, right?
Why wouldn't they do it? I mean, they've got to put their capital to work somewhere. They're flush with money. They've got so much reserve capital to spend that to buy their own stock is something that makes perfect sense. Some of them pay dividends and raise the dividends, but that helps. But again, if all of this driven capital is what's making these stocks go up, what happens when I'm not able to offer you money cheap anymore? Or what happens if your cost to borrow that money can't be covered by an increase in your stock value?
Right.
Well, then you're going to stop doing that. And then what happens to your stock? Well, now it's only going to go up if everybody really believes that the stock is worth the money. Now it's going to come back to actual earnings, the real fundamentals, the things Warren Buffett would pay attention to. Are they really earning money? How is their manufacturing looking? What's their inventory look like? What's their sales and cash flow, and how's everything running there? They're back to the fundamentals. We are nowhere near fundamentals when it comes to values for stocks. They are not trading on fundamentals by any margin whatsoever. No. They're all trading on the influx of cheap money, and that's been the case for almost 2 years. I've raised this concern a while back, and I guess I'm a little bit early, but we will feel this impact in a retraction in values of stocks when the party ends, which it has to come to an end, because the Fed cannot continue to play this game of printing and printing and printing indefinitely. It's beginning already to find the problem. The problem is the cost of everything we're buying is going up. And then the Fed turns around publicly and says, oh, we were shocked by the rate of inflation this month.
Oh, we're just shocked.
We never saw this coming. We didn't know. We didn't expect it. Look, energy costs, manufacturing costs around the world. Europe is experiencing the highest inflation rate it's seen in 15 years.
Is that right? Huh? Has the ECB been doing similar? They've been buying a lot of stuff as well?
Yeah, and they're about to start raising rates because, they're at that point now where they've got to address this problem too. Not only that, but now we have another problem, which is sort of a byproduct of all this COVID stuff, which has been a shipping issue.
Yeah.
The transportation world is going through the massive changes that have been a result of a limited amount of literal employees. You for a while had curtailed the number of people that could work. The trucking industry, there's been rumors around that they're threatening to strike in a number of different areas within the trucking world. I think they have the greatest leverage they've had in my lifetime.
I think in Australia they're going to pull it off, I think, today. I think in Australia, a huge trucker strike. Yeah, that's what we've been seeing, yeah.
I can see that, right? I mean, they've never had a better pressure to apply than now. And the manufacturing problem is now becoming a transportation problem. The ships that are laden with crates that are sitting in the ocean because they can't get into port because there aren't enough physical people to take the crates off of the ships. They can't even get the equipment down to pick up the crates off of the ships.
It's all backed up in LA now, right? That's where it's backed up.
Dozens of ships off the coast of California. 1 to 3 ships off Long Beach was considered a huge backlog a year and a half ago. There have been as many as 36 of them off the coast of California shores, sitting in the ocean, waiting to be unloaded. And the crane operators, guys were paying $500 to get a guy to operate a crane and just get their ship unloaded. They're paying $10,000 now.
I heard that. That's crazy.
$10,000 to get a guy to take his equipment down to start unloading the ships. And as that cost continues to perpetrate, the shipping is now having to pass these costs along. They have not filtered yet through the economy. So if you think we've seen inflation and cost increases
just starting
now, just wait. We're going to get a lot more of this. This is a bigger problem for the Fed.
We've been selling these. Here's a perfect example. We've been selling these saunas here from. Let me show you a quick little picture of it. For I guess 10 years. And, they've gone up a little bit over the 10 years.
Imported?
Yeah, and they come from Taiwan.
Oh,
yeah, they come from a medical university in Taiwan. I'm in mine every day. It's called the Relax Far Infrared Sauna. They're really great. And so now, I think about 30 days ago, they gave us a price increase of $100. I know the fellow that owns it. He's a great guy. And they tripled the cost to bring like 100 of these in, or whatever they do at a time. Triple.
Sure.
Yeah.
There's nothing we can
And
do
so
about it.
we had to raise our prices $100 to $12.95 from $11.95, which is still a good deal, but you can see how that trickles down already from the shipping, right?
Right.
Yeah.
And there's an example of it directly. That's exactly how that will filter through.
That's how
right?
it works,
So
right?
it starts the shipping. It ends up becoming a trucking problem. It ends up becoming an additional cost that gets passed along eventually to the consumer. But let me tell you, the guys in the manufacturing world and the transportation world, they were fighting having to raise prices. They didn't want to have to do it.
They didn't want to.
They didn't want to do it. They didn't want to be responsible for cost increases at a time where nobody wants to see that in a slow economic environment. But they were forced. Their hands were forced. At some point, I talked to a guy in the construction business at the peak of the lumber problem. Was bidding a job 8 months out, and by the time he was finished, the cost of his lumber had increased more than he had added to the cost of the job for his profit margin. It had been wiped out. So, this experience of raising prices and filtering through the economy, which is the way that we experience inflation. We have talked about this a lot, that the way I look at inflation, it's anytime that money supply has expanded greater than GDP, the result of that shows up later on, which is the eventual cost increases. When that begins to become a problem, because we're way past the idea that we can slow down now the money flow, it's already out there. Now it's beginning to have its impact. So everything behind us in the last 6 months, it's still got to come forward. We'll be seeing this. So where are we now? September. So October, November, December, January, February. We'll be in March of next year before we get the final impact of what we've done now.
Wow.
And if we continue the next 6 months, printing more money, adding more, and the Fed keeps buying 100+ billion a month, keeps pushing money into the economy, this is not going to stop anytime soon. And by the time this cycle is run through, price increases on things are going to just, make 5-year-old prices look like the days when Grandpa used to tell us stories about how cheap
it could be
things
that
were
much?
he used to.
We could go through the same model as in the 70s then, you think?
Well, I think, if we don't see 30% increases across the board on average consumer things, I will be stunned.
30% between in a year from now?
Yeah. Energy costs, cost to buy a car. Look at the weirdest things. Microchips are now becoming a big problem. You can't get microchips shipped to China fast enough, so suddenly the cost of computers are going up, and cars are going up, and everything having to do with electronics are going up in price. Food costs are increasing because, again, the shipping problem is becoming huge. Most Americans don't realize how much of the food that's on your local supermarket shelf does not come locally resourced. It's all imported.
Yeah.
We import vegetables from Vietnam. We import all of our food from around the world. And that is becoming much more expensive, both because of this weakening dollar. And then on top of that, you've got this shipping problem. So when all this is said and done, I would be surprised if we don't see in general a roughly 30% increase in the cost of just about everything that you buy. Any physical thing from, aluminum, microchips, lumber, I don't care what it is, it's going to cost you a lot more.
And what happens when, Richard Mayberry's on the show once a month, and you and Andy Tab talk about the money velocity, right? Which is not, it's a certain level, kind of medium, not too much right now, looking at the charts. So when people start to get that maybe this computer is going to cost more 6 months from now, or maybe this card table or couch, they're going to increase the velocity, right? They're going to start spending. Now, does that then also, that makes the prices rise as well, correct?
Absolutely. And it creates a big problem because a lot of times the manufacturers can't build or get shipped in. And then the next thing you know, that couch that you would order today that normally maybe you get it in 2 or 3 weeks.
Right.
Now we're talking maybe 3 or 4 months.
And then people are willing to pay more for it too. They'll go somewhere else.
Well,
they'll say, "Oh, I want to get this one over here. I know it costs $200 more, but I want it now." That kind of thing too.
Well, if you were the guy selling it, wouldn't you do that? You'd certainly put the guy at the front of the line who might be willing to pay a little bit more. And what does that end up doing? It just raises the prices of the goods across the board.
It's crazy, man.
The only thing that will change is I think the real estate market will not continue to go up indefinitely. It will continue to climb for quite some time now, but within a period of time, I think the Fed is going to slow down its asset purchases of mortgage securities,
Right.
and that will create a kind of a top, of the market there. I've heard from the biggest manufacturers like the D.R. Hortons of the world. They're estimating that there are 800,000 houses short, in America right now. In other words, demand we need to build another almost 1 million houses just to house everybody who wants to buy a home right now.
Is that right?
Yeah, so there's huge demand out there. But if you're selling your home, it's about the best environment you've had in decades.
Best time in the
You
world.
can pretty much command your prices. And I know people that are doing this nonsense now. They're buying houses they don't want and doing almost nothing to them, and then just raising the prices 10 or 15% and putting it back on the market the next day. And they're selling. The same home is selling 3 or 4 times over in a matter of months because demand is so great. It's just a ridiculous market. That we need to recognize those markets when they exist, because when they're gone, or somebody who bought at the top, suddenly finds themselves with that big change in value and overextended themselves for a mortgage they couldn't afford, and then the value of the house drops, that creates its own problem.
Yeah.
So I'm a little bit worried about that.
Fred Dashevsky is with us, OneRadioNetwork.com. Here's his company. It is U.S. Coin Capital, and it's 800-878-2646. And talk to him about currency silver or the numismatic coins, the $20 gold piece, etc. And they'll take real good care of you. And I've known Fred forever, long time, good man, partner with one of my best friends, Andrew Goss, for many years. And they're not going to try to sell you a bunch of stuff. And you just don't do that, do you, Fred? You just don't put people into coins they shouldn't be in. It's just not the way you guys do business. You just don't do it. You don't do it.
First thing we're going to do is make sure people understand what the benefit is and how this works and where they would gain from doing it and where they wouldn't.
Right.
So I have turned down, I can't tell you the numbers, that they're ridiculous. How much money I've turned down this year from people that were speculating on, I think this is going to happen in the next 3 weeks, and therefore I want to buy, $500,000 worth of gold or silver because I believe the price is going to explode in a month because I think this is going to happen. I keep telling people, don't do that. Do not. I love the business, but don't do it. That's not the way to do it. This is a minimum 5-year hold for people because you need time for the inflation to chew away the value of the money to let the prices of these things increase. But I think everybody should be protecting their wealth and diversify to make sure that a portion of that capital you're putting away for 5 years from now is not tied to paper. Because I think the likelihood of a change in the nature of money is much greater now than ever before.
Oh, of course.
And specifically focused on the change in the value of paper dollars. Meanwhile, the prices of gold and silver coins are climbing. They keep creeping up little by little. The price of silver, years ago when we were selling silver between $3.50 and $5 an ounce, we could barely give it away. And then we hit that $8 to $10 range, and then it became 11 to 12 and 13 and 15, 18. Now we're in a range of roughly $25 to $30 an ounce, and 5 years from now it'll probably be $30 to $35 an ounce, and $40 and $50 an ounce. It's just going to keep creeping up. Again, if you think about it, you've got a fixed supply number of dimes and quarters and halves in the world, and an increasing supply of paper money with no end in sight. You keep doing that math, and that cost of that dime and a quarter have to keep going up. And we are experiencing that increase on the coin side for the first time in a very, very long time without a massive change in the price of the underlying metal. That is a good indicator that the supply-demand characteristics are quite tight.
I've got a theory about this whole Fed coin thing. Have you looked at it? Do you have any ideas on its practicability and timing?
Well, timing, I don't. Practicability, sure. I mean, it's certainly
They're
feasible for the
right?
Fed to turn around and, hey, we'll start issuing a Fed coin as opposed to printing that paper note.
Right.
There are a lot of technical issues and things that they would have to work out, that will provide them with a lot of problems to get that accomplished. And again, public acceptance is going to be a long road. It's going to be very difficult to get everybody on board. It'll take time for people to kind of get adjusted to the idea. But, if 10 or 20 years from now, you and I are still talking, and we're talking about now that, a digital dollar, instead of a paper note being printed, To me, it really doesn't change anything. I mean, effectively, I think we're already in a digital dollar per
Sure.
se,
Right.
even though they print paper notes, for all intents and purposes,
Or
a
digital
number
now,
of
right?
times. Yeah, I mean, everything is effectively a digital representation of money anyway. So it really doesn't change much. The only thing it really changes, and the thing that concerns me more about it than anything else, is the lack of
But yeah, sure.
being
Right. Yeah. Also,
right?
Fred, we're hearing a lot of people talk about this idea, as they're doing in China, where the Fed coin would be through only through your cell phone, and then that way, then it could also tie it into a social credit score, your regular
Sure.
monetary credit score, social credit score if you're being good, really spooky, globalist, crazy stuff, and
Oh yeah, you
I
throw
wouldn't put that
line
past
out.
him.
That's
Yeah, I wouldn't put it past him.
problematic. But transparency was the word I was choking on there for a second for
Right.
no reason. We lose the transparency if we move to digital currencies because we can't count money anymore if they don't print it. You go to that Fed balance sheet, you can watch that increase in money supply. That's going to be a lot harder to track if it's all digital. And then, yeah, if they want to start socially engineering,
Stuff.
pressure on people, right? Imagine that it was that old, somebody had come up with this idea that, you go to your cell phone and you try to order a pizza and it comes back and
Right.
says, I'm sorry,
That's
Patrick,
right.
we found that
Your cholesterol level is too high. Listen, I wouldn't put it
Cholesterol's too
past
high,
him.
so
And with
you
5G,
can't
you
do
could
that.
do it. You could do it.
Right? It rejects your purchase, right? Social engineering based on money.
Yeah.
That's a scary process.
I know.
That's
That makes
more
George
than
Orwell. Yeah, boy. But you talk
Which makes
about
him
the
look tame.
transparency, Fred. We've seen that, and that the MZM and the M3, they've canceled all these charts, right? We can't even see them anymore as of last February on Fred in St. Louis. They're gone. So we don't. They've canceled a lot of that. And I'm looking at the U.S. debt clock this morning, and there's something not right with this thing. I think they're cooking the books here, Fred. 28 trillion, 700 billion. It's gone down a couple trillion. How did that happen?
It depends on what they count.
Well, yeah, but it used to be this website, the U.S. debt clock, the real fancy one. It used to be 31 because I check it. So they've
surprised by that.
they just cooked the books on this one.
Yeah, I don't know how they justify that. I can't imagine how that works. When the Fed's balance sheet has not gotten lower, it's only gone up.
Yeah,
we've gotta be
8.5, right?
8.5.
Yeah, 8.5. Also, I've noticed something on the Fed's balance sheet today. Generally, they have 3 weeks. They show you increases over the last 3 weeks. They've moved it down to 1.
Yeah.
Oops.
Well, it could be busy.
Yeah, I don't know. No, they usually have 3 columns, right? They tell you this week and this week. Now it's the only thing you can see is how much they've gone up between August 28th and, August 18th and August 28th.
Yeah, so they're a little bit. They're
Oh, I'm
almost
sorry.
up to
No,
speed. This is
they've
always-
got 18 to 20. Now they're cooking it. I don't know what they're doing here.
Well, think about how convoluted all that has become. I mean, it used to be a lot more straightforward.
Yeah.
It used to be a lot easier to read those numbers and know what was going on. Look, the more people figure this stuff out, the more they have to sort of obfuscate the numbers to try to keep people at bay from really getting a grasp on this. Can you imagine if a large percentage of the American public understood the rate of inflation that really existed and what it looked like going out the next 5 years, what that would do? I mean, I don't know. It would change the way that people would think about their retirement accounts and, how much they contributed to 401ks and things of that nature. I don't think a lot of people would be comfortable if they really had a fundamental understanding of what was happening, which is, look, why programs like this are great, Patrick. You've been
We
doing
have to,
this
do
for
what we
so
can.
long. Help
Man.
people at least get.
Man, oh man.
And I do, since, we know we can't change what the government's going to do, and we're not going to influence the Fed's actions. They're going to do what they do one way or the other.
That's right.
And we'll just have to try to unravel through the crap, sift through all the bull and see if we can come up with, an understanding of what's happening. The one thing that I think will make people feel safer, more secure, more comfortable is if a part of their assets are in something real, tangible, physical. And again, I love the idea of gold and silver coins because it's legal constitutional money. It was the intended currency for a public, and they can't make any more of it.
Yeah.
I mean, what a wonderful way to work, to put money away for your future.
Can't make any more. Well, if you'd like to talk to Fred about getting in somehow and, talk to him, just tell him what your goals are and what your budget is and what you want to do. And these are the kind of people that'll just lead you in the right direction, hold your hand through the process, and get you going and get your toe in the water and get you moving around.